Well, welcome everybody to the HSF Kramer Defining Matters series. I'm joined today by Matthew FitzGerald. Matt, it's great to have you.
Thanks, Cam. Great to be here.
Now, we are covering a blockbuster episode this week. We have just released our Private M&A Report, which is the empirical analysis of all the private M&A deals, or a sample, I should say, of the private M&A deals we did last year. And of course, Matt, you had two of the defining matters that form part of that report: the Sushi sale for Odyssey Partners, and then also the Resolution Life sale, which was a cracker of a deal. So well done to you.
Thank you. Yeah, it was an exciting year, and it was a bit of an unpredictable year. There were some really big deals, but also there was some choppy activity. So it was hard to know where the market was going to go. But pleasingly, a lot of deals were done, which is what we like to see.
Absolutely, and the data supports you, Matt. We recorded $36 billion of transactions in our sample of 60 deals. That was up from $14 billion in the prior year. Now, you think about what's happening in geopolitics, you think about what's happening in macroeconomics, that's a really resilient result.
Yeah, but look, it's really impressive. And I guess to me, it underlines the strong fundamentals of Australian businesses, but also the strong presence of financial sponsors who are always looking at growth opportunities and also exits, which I think help drive a lot of the activity.
Absolutely. And I think the exit pipeline, I want to say it's starting to thaw, and what was a really defining feature of the data set are deals where an auction or a soft sounding was reported, and then there was a long duration before a bilateral deal was done. So we'll get into the dynamics shaping the market.
Yeah, and it's interesting. Obviously, when you're on a sell-side process and you're acting for the vendors, you really want a competitive process. You want a bit of competitive tension. But at the moment, it is hard to get that. There are some processes that are competitive, but a lot of them, there are only one or two serious bidders. And I guess in the end, you only really need one serious bidder, but ideally you have two. And unfortunately, in the current market, not something that you can control for, but I guess there are a few things I think you can do to try and maximize the opportunities to get the exit. And one of them is being very organized, very pragmatic about how you can move forward, and also listening to what bidders are telling you on key deal terms. And that's, I guess, one of the key themes that also comes out from the report, what we are seeing in the market in terms of execution terms of deals that actually do get signed and closed.
Absolutely. All right, let's get into it. An empirical study of 60 of our deals, that's a sample of the private M&A deals we did last year. The distribution of those deals by value is quite interesting for me, Matt, because what we see is, first of all, at the big end of town, 17% by a number of the deals were above $1 billion. That was triple what it was last year in CY24, which was 5%. So I want to tentatively say the big deals are back.
Yeah, which is really exciting. We all want to work on big deals because they're interesting, they're complex, and often they have a lot of regulatory issues to work through. So it's great to see the big deals are back. And in a funny way, sometimes bigger deals are easier to execute because there's a high materiality threshold that you're working with, and that can mean parties can come together more quickly to get a deal done.
Absolutely. Now, the smaller deals should not be neglected, and
of course,
67% of the sample size were under $250 million. What that demonstrates for me is that people think of us as a big law firm doing big deals. Absolutely, and we love those. But the bulk of our business is actually mid-market and smaller M&A. So we're very skilled in doing that, very efficient in doing that, as shown by the data point.
No, exactly. And it's a very important part of what we do. And we're very skilled at executing deals efficiently and effectively. And whether the deal is big or small, I guess we're keen to be involved in those because you want to be involved in as many deals as possible to also get a better understanding of what the market is doing and how the market is evolving in terms of key transaction terms, which I think is another thing, obviously, that we'll talk about today.
Yeah, and I think the league table results have just come out. By volume, we're number one again. So we get the biggest share of M&A, both private and public. And, again, the data supports our sort of dominant position.
Yeah, it was very pleasing to see those results, and obviously we're very grateful to our clients who have, engaged us to help them on transformative M&A, but also, smaller M&A, divestment of non-core assets, also bolt-on acquisitions. We're seeing a lot of different types of M&A in the market, and I think that's indicative of the fact that it is a little bit fragmented at the moment, and it's hard to know where things are going to go next. But hopefully, it will continue to be solid, and we'll see more and more activity driving M&A into the next period.
Now, speaking of driving activity, what did the data tell us about what's prompting a transaction? Can you give us a bit of a breakdown of by seller type, effectively?
Yeah, so I guess with seller types, there's probably 2 or 3 buckets. The most obvious bucket will be no surprise to anyone, which is private equity exits. And so PE are obviously in the business of buying and selling assets, and the key piece is to obviously buy low and sell at a good time. And so private equity are driving a good number of our transactions on the sell side. But the other piece that we're seeing a lot of is corporates doing strategic reviews and getting rid of non-core assets. And every sophisticated corporate is regularly looking at their portfolio of businesses and business units and thinking about whether those business units will serve them well into the future. And so non-core divestitures following strategic reviews is another key driver of activity. And obviously that creates complexity because when you're doing a non-core divestiture, it's typically done as a carve-out, and carve-outs are complex. And so we are seeing a lot of carve-outs as well. And then I guess the last thing I'd comment on is we're also seeing obviously some IPOs coming through. And so whether there's a return to more IPOs or dual track processes, that's another interesting thing that I'd like to sort of think about, because that is another potential avenue that people looking for an exit can look to.
Yeah, the exit optionality is expanding, Matt. And I want to touch on a couple of new sort of options for liquidity that are coming out. IPOs definitely are coming back is one, but there's 2 others we'll touch on later on in this episode. Matt, I want to ask you about the dynamic for sale processes. And I pause on the phrase sale process because they're very fluid processes these days. What I think anecdotally I'm seeing is that there is a clear bias for sellers to try and lock down with a bidder as early as possible and achieve deal certainty with one bidder, rather than the hell for leather, broad-based competitive auctions we had seen historically. That's on the sell side. On the buy side, I think what's transpiring is there is a bit more coyness early on in a process from bidders, as they have acknowledged that sellers have that preference and they don't want to be a stalking horse for a preferred bidder. So this sort of change in approach to an exit has been quite interesting, and I think it's shaping what the sellers are preferring is also shaping how the bidders are responding.
Look, it's very interesting, and I guess just to sort of unpack that a little bit, a well-advised seller who's looking to exit quickly and efficiently will often front-end a lot of the hard work. They'll do a lot of vendor due diligence for 2 reasons. One, obviously to help bidders get up to speed quickly, but 2, to also make sure that their house is in order. And so a good exit process on the sell side involves a lot of preparation, and you want to know what's going to come up in due diligence and how you're going to deal with it. And so vendor DD, financial, tax, legal, operational, commercial really puts you in the box seat to have as smooth a process as is possible. On the buy side, obviously, you're keen to go into a data room that has a lot of vendor DD, that's well organized, that's well structured, and you don't want to spend a lot of money as a bidder unless you know you're in with a really good shot. And so I guess what I have seen more recently is less bidders wanting to spend a lot of money on their external advisors until they know where they're up to. The other thing that seems to be a new feature is valuation check-ins multiple times through the process. So this is where the sell side want to make sure that the bidder isn't going to do a price chip at the very end of the process. And so that's another tool that we are seeing more of to try and create more certainty on valuation so that there are no nasty surprises when you get your binding bids in. And I guess the final piece, which you've touched on, is bidders are being more aggressive in their tactics and often seeking exclusivity earlier than would ordinarily be the case. And so what that seeks to do is take control of the process a little bit away from the seller and make it more a bilateral negotiation, which obviously changes it from a competitive process into exclusive negotiation. And as to whether that's appropriate on a particular deal, well, it really depends on how compelling that offer is from that bidder who's looking to lock down exclusivity. And I guess also their track record of executing on deals, which I think is a key factor that the sell side would need to consider before they go down that exclusivity path.
Yeah, it's a real balancing act because sellers want to see conviction from a bidder as early as possible. But as we talked about, there's a bit of coyness from bidders. So there's a fine balance for bidders to tread. Now, back to the statistics, 74% of deals were done on a bilateral basis or an auction that collapsed into bilateral. I mean, that's a huge proportion of deals. Now, some of those smaller deals that make sense, you're dealing with a small founder, bilateral makes a lot of sense. But as I said earlier, I think the broad-based competitive auctions, that dynamic is changing and we're seeing less of those.
It is, and I think part of that is also large corporates at the moment are probably a little bit reluctant to execute a massive deal, particularly if their sector is facing a little bit of uncertainty. And so I think boards are pausing on decisions, particularly bet the company decisions. And so that means that processes are taking longer as boards are carefully considering what is the right decision to take on this strategic M&A. And so I think that is also one of the factors that's driving some of these bilateral discussions. Less people are prepared to really commit up front to go hard at something, and they're really pausing to wait and see, well, where's this going? How's the performance tracking? And is this something that they really want to double down on and execute?
Yeah, absolutely. All right, so that's the early stages and nature of engagement. Let's switch to transaction certainty, which I think is the other big feature coming out of the report. In last year's report, we foreshadowed that we thought MACs were going to be an area of focus. Now, that was before main and cassette, albeit it's a public deal. But we just had the sense that the settings were there where MACs were going to come into focus. And we saw a couple of instances where MACs were triggered or intended to be relied on. What the data shows on private M&A, Matt, is that 30% of deals had a MAC termination right. That's down from 38% in the previous year, in calendar year 24. So I take away from that two things. One, MACs are fertile negotiating ground. You often have this debate around MACs are absolutely not standard. The sellers will always tell you, you've never seen a MAC. And the buyers will say, absolutely, got to have a MAC, can't be exposed during this period. And the data's saying, well, it's a 30% rate of getting it. And so, as I say, very fertile negotiating ground.
Look, absolutely. And obviously with MACs, the beauty is in the eye of the beholder. If you're on the sell side, MACs are something to be resisted. But if you're on the buy side, MACs are a fantastic contractual mechanism or lever to pull. And I think for me, one of the reasons MACs are probably becoming more common is the regulatory landscape is becoming more complicated and more deals are needing regulatory approval. And so why is that relevant? Well, it means that there's a longer period between signing and completion, and therefore more that can go wrong in relation to the business, and therefore more risk that the buyer has to assume. So I feel like one of the reasons MACs are becoming more common is because most deals have a significant regulatory approval. A lot of them have 2 regulatory approvals. And so what that does is it pushes out the completion date and therefore enhances risks of potential things going wrong. I think the key thing though, with a MAC, it has to have objective, sensible, carefully framed triggers so that you avoid a hair trigger. The purpose of a MAC, in my mind, is really to protect the parties for something cataclysmic happening, which means that the buyer is not getting what they thought they were getting.
Yeah, absolutely.
It isn't about hair triggers, and I think that's always the challenge. How do you set the criteria for the MAC to be enlivened to avoid hair triggers, but also to be as objective and clear as possible so that the parties aren't relying on a court case in order to determine whether it's been triggered or not?
Yeah, absolutely. And so going back to the data, 90% of the sample set had a quantitative MAC, which is very different to the global experience. More often than not, particularly in the US, it's left to a qualitative test. So 90% quantitative. And what we saw in calendar year 25 was the thresholds have gone up. So I think, again, that theme of MACs being in focus, sellers being hypersensitive to the risk of a MAC being triggered. So the earnings limb, the median was 23% of earnings, and the net asset limb was around the 20% mark, and that was up from 13% and 15% in the previous year.
And I like that because I think that's closer to what we're talking about in terms of a cataclysmic event or problem with the business. 10%, 12%, that feels to me a little bit low for a true MAC. And obviously, in the end, it's always a negotiation between the parties. but you want to have a fair allocation of risk. And if one of the reasons the period between signing and completion is so long is because of the buyer's regulatory requirements, well, that's something that has to be factored into account in terms of how you're allocating execution risk.
Yes. Now, you've touched on regulatory approvals. We've got the data on duration or time taken to get those approvals. Do you just want to talk about FIRB and ACCC and what we're seeing?
Yeah, absolutely. So FIRB and ACCC, as we were talking about earlier, are becoming more and more common in terms of regulatory approvals in the Australian market. And obviously, with FIRB, this isn't a particularly new thing. And the reason for that is the thresholds are relatively low, particularly if the foreign investor has foreign government investment affiliations. And so many deals require FIRB approval these days, albeit that it's a well-trodden path. And thankfully, even though bidders will have to pay a FIRB filing fee, the processing times have actually got better in the last 12 months. So that's a positive. The ACCC is more complicated because of the new regime, and so more deals are requiring ACCC approval or a waiver process, and that can be complicated or it can actually be relatively simple. I think the key with both FIRB and ACCC is to understand the likely needs early so you can plan for them. And if you can plan for them carefully, normally you can have an orderly process. And you've got to make sure that the documentation is appropriately balanced to make sure that the conditionality on any approval appropriately reflects the intentions of the parties. And that's where you can get into a little bit of difficulty if the parties haven't fully thought through the likely conditions that FIRB or the ACCC might place on a deal. And the other point, I guess, just in closing, you would normally know, based on both counterparties, what the likely risks will be from a competition or FIRB perspective, and you can actually try and proactively solve for that. So careful planning, I think, on both the buy side and the sell side is necessary to navigate what is an increasingly complex regulatory environment. But look, there is a pathway through, and the pathway is generally a good pathway because FIRB rarely rejects deals. And the competition authority is also looking to make sure that deals are done, but there are more conditions often being attached to approvals, and so that's something that has to be carefully thought about when you're negotiating on deal approval terms.
Yeah, and I think, Matt, on timings for approval, FIRB approval came in a median of 68 days versus 90 days in calendar year 24. Obviously, it very much depends on what those deals are, but the shortening periods are always a good thing. The ACCC approval process, look, for mine, it's obviously added to the process, but I don't think we're seeing perverse or unusual outcomes. We certainly saw in the back end of calendar year 25, a lot of people lodging waiver applications ahead of deals they expected to be done in 26. So there was a flurry of activity, and that also drove down the ACCC review times. Back to your point on conditionality of an approval, I think there's been a lot more work done up front by the sell side as to what conditions must be accepted by the buy side.
Yes.
We're not seeing hell or high water provisions. It's not to that extent, but certainly that discussion is being brought much earlier. And in fact, bidders in a competitive process are expected to mark up an SBA and show where they're not going to accept conditionality, so that, again, bringing into focus transaction certainty for the sellers.
Look, absolutely. And I think that's a key thing that you've got to get right. It's got to be reasonably balanced. It's got to take into account market practice. But in the end, the reason you're signing up to a deal is to execute a deal. And if you have clarity on what conditions will be acceptable and what won't be upfront, it gives you a much better chance of knowing whether you're going to get a deal done or not. And the sell side really do have to drive that, because in the end, they want to execute the deal. And so they need to make sure that their documentation will hold up, it will be reasonable, but it will also make sure that there is a bias towards execution, which I think in the end is an important driver of any deal.
Yes, and there's a lot more time being spent on, the old words used to be conditions acceptable to the buyer acting reasonably. I think these days there are preloaded conditions which must be accepted by the buyer side. Matt, I want to change gears. Purchase price structures. What did we see in the data last year?
Yeah, so purchase price structures is interesting because historically this market has had a strong bias towards completion accounts, which is similar to the US, whereas in the last 12 months we've seen a real resurgence of lockboxes. Now, as I think many will know, lockboxes are the preferred mechanism in the UK and also in Europe, but they're not as common in the US Historically, they haven't been as common in Australia, but now I believe they're used in 29% of deals. And so that is telling me that they are becoming a much more accepted tool for a purchase price adjustment mechanism. And obviously, the benefits of a lockbox are, significant. It's a simple, clean process which takes largely off the table what is often the most common dispute on any deal, which is how the purchase price adjustment mechanism works. And so early adopters of the lockbox are the private equity vendors who are looking for a clean, simple exit. And so I would hazard a guess that many private equity sponsors have that as their preferred mechanism in Australia, even though it hasn't been as popular in this market when compared to, say, the UK. And it is becoming an increasingly common tool, and I think the trend will continue. Yeah. So my suspicion is that lockboxes will move closer towards 50% of deals, because everyone's understanding how they work, and also the simplicity that it does offer in relation to a completion mechanism.
Yeah, absolutely. And the certainty of exit proceeds, the certainty that a lockbox provides, is really valuable.
Yeah.
I don't know what you're finding, Matt, but I'm certainly finding more and more discussions with vendors being, how do we structure for a lockbox? How do we time our process or our bilateral engagement vis-a-vis audited financials? Yes. In order to allow an efficient lockbox process, because that's often the key diligence consideration.
It is indeed. The other piece is a little bit on whether the business is seasonal and whether it's affected by seasonality. And if it is affected by seasonality, that can create some complications. But there are ways of managing for that. And I think as this becomes more and more common, it will become, I think, almost a standard mechanism that will be utilised. And the other thing I guess we're seeing in many data rooms is the lockbox memo, which is prepared by one of the accounting firms. They will set out the basis for how the mechanism will work, often in a very clear, simple way. And again, that helps bidders get their head around the mechanism. And obviously, for some bidders, it's not something they're familiar with because it hasn't been the primary tool for purchase price adjustment mechanisms, but it is becoming more and more common. And I do think that trend will continue.
Yeah, I agree with you. And what we're not seeing anymore, if you go back 5 or 10 years ago, you'd have we're going to do a lockbox from the sell side, and then the buyer say, your diligence doesn't support that. We're moving to a completion adjustment. These days, people are well prepared for the lockbox when they launch with it.
Lock it in.
Very good. Now, other purchase price consideration trends. Earnouts edged up slightly last year. Deferred consideration edged up, scrip rollover edged up. So all of this, I think we're seeing more at-risk consideration, more attempts to try and bridge buyer and seller expectations on value. So that's definitely coming into the conversation, and where earnouts are definitely starting to play out.
Absolutely. And obviously, as you've alluded to, the reason for that is there needs to be a mechanism to bridge the valuation gap. And at the moment, it feels a little bit like COVID, where some businesses are going incredibly well and you don't know whether it's a spike or whether it's sustainable. And so how do you solve for that? Well, you use one of those mechanisms that we were talking about, whether it's an earnout, whether it's deferred consideration. And so I think, again, obviously there are difficulties with earnouts and deferred consideration. With earnouts, it's important to make sure that you're comparing apples with apples. It's also important that the vendor has appropriate oversight around what the buyer is doing with the target business, so that there can actually be an accurate comparison of what the figures are which trigger the earnout. And then I guess deferred consideration, depending on the timing for that, you are taking credit risk on the buyer. And so you need to understand, well, is the money going to be there? And what type of security, if any, can you negotiate to give yourself comfort that when the deferred consideration milestone is hit, you are actually getting paid that deferred consideration. Where I think it's particularly complicated is if when you're on the sell side and the deal doesn't make sense unless you get those further deferred payments. That's when it really comes into focus, as opposed to the deferred consideration being the cream on the top. You would have done the deal anyway, but the deferred consideration makes it an even sweeter deal. In those circumstances, you're probably a little bit more relaxed about some of those factors. But if you're banking on getting that earnout or the deferred consideration, as the seller, you really need to make sure that you have appropriate mechanisms in the documentation to protect you for the various things that can actually go wrong in that post-completion period.
Yep, and of course, the deferred contingent or equity consideration also is useful for buyers in case there are post-completion claims as a source of security. So that's also useful. I wanted to use that as a segue to talk about post-completion liability and what we're seeing in the data. Look, this part of the report is really dense and there's a lot of good statistics for what is market. Of course, that market has been driven in large part by W&I insurance, given the massive uptake we're seeing of that. But to give you a sense, in terms of claims liability for general business warranties, we're sort of seeing about 28% of the purchase price being the maximum claim limit. But it's a tale of two halves. Deals under 500 million, it was about 33%. Deals above 500 million, about 12%. So certainly at the bigger end, I think that's tracking where the policy limit for a W&I policy generally sits. But the smaller the deal, the bigger the percentage of the cap. Time limits also contracted in CY25. We went from 30 months for general business warranties down to a median of 21 months. So again, there's a general shift towards a heightened risk sensitivity on the sell side.
Yeah, and it's interesting. I think this really has been driven by W&I, as you say. That has completely changed the M&A landscape. And I know that W&I is not used on every deal, but it's certainly used on almost every private equity deal. And it's becoming more common with corporates as well. And I think what that has driven is, I guess, a change in the way we approach claim limits, time periods, the warranty set, and also risk allocation. But of course, if that product is not being utilized, you do need to think about it a little bit differently. And you do need to think about some of those basic principles where if you're acting on the buy side, what is the seller going to look like after the deal is done? Is there going to be creditworthiness? Is this a carve-out sale from a large corporate where you know there's a strong balance sheet? Is this a founder who's selling his or her entire business and therefore creditworthiness isn't a thing? And so the other point, I guess, to make on that is that sometimes if you're on the buy side, you may actually be saying to the seller, we should use W&I on this deal. So typically it's driven by the sell side and they'll do a W&I flip to the buyer during the process. But if you're worried about some of these issues on the buy side as to how are you going to recover from the vendors, it is actually something to think about in terms of whether you deploy the product. It is much easier to use these days. We are seeing it on most deals, particularly with private equity involvement. But I think the other piece to remember is that you can only really use it if thorough DD has been done, because the success of the product is basically inextricably linked with your due diligence. If you've done really thorough due diligence, it works really well. If you haven't done really thorough DD, it's difficult to deploy. And so that also needs to be taken into account. But, in conclusion, I guess, every deal is a little bit different. And I think it's hard to compare the data from a really big deal to a small deal because they're just very different comparison points. And so sometimes the stats can be a little bit misleading because you can often have stats to support any particular position.
That's right. Not our stats though, Matt. Our report does dissect by deal size or sort of categories of deal size. So we do adjust for that consideration. Just on W&I to close it out, what I find quite interesting is who bears the cost of the W&I policy, because of course a seller gets a benefit in the form of usually a clean exit and the buyer gets the benefit of greater certainty or not having to get security over the warranty claims. What the data is showing is these debates about the sellers wearing the cost of a W&I policy have almost evaporated. The vast majority of instances, the buyer absorbs the entire cost. In a minority of cases, they might share the cost with the seller, but the overwhelming market position is buy side takes the cost on a W&I policy. So it's interesting that debate has sort of...
Yeah, I mean, and that's definitely what I've seen on deals as well. The buyer does bear the cost. But again, a little bit like stamp duty, often what buyers will do is they'll look at the price that they're paying, the purchase price, they'll look at the stamp duty, they'll look at all of their external advisor costs, and they'll also look at the insurance premium, and they'll take that into account in their final bid price. So whilst I think in almost all cases the buyer definitely does bear the cost, the question is always, are they chipping their final price a little bit to take into account the fact that economically they are bearing that cost in the deal execution terms?
Yeah, absolutely. Seen and unseen costs, I think, Matt. So, look, we've touched on a very brief set of the data points in the report. It's 40, 50 pages. It is incredibly dense with data. For transactors and deal makers, we call it the Deal Makers Report. For deal makers, it's must read for any transactor in this market. It'll tell you what market is. It'll tell you what strategy and tactical shifts are happening in the marketplace. It also touches on predictions, and I want to hear your predictions for the year ahead, maybe the 1 or 2 years ahead. What do you think we're going to see play out?
Well, look, despite geopolitical challenges continuing, I still think there'll be a strong execution of big ticket M&A. I think there'll be a lot of mid-market M&A, and I also think there'll be some takeover activity. So I'm very optimistic about the next 12 months. I think it will be even better than the last 12, and I think there is still uncertainty, no question, and some boards will be nervous, but there's so many positive signs. You know, whether you look at the data center activity, whether you look at critical minerals, whether you look at Gen AI, there's so many exciting things happening across a number of different sectors. I think that will drive activity. The other ace I think we have in our pack is just private capital. Private capital is always looking to execute on deals, both on the buy side and the sell side, and that will continue to drive activity. So even though there have been some challenges, I think the next 12 months are going to be very strong, and I'm really excited about what it holds.
Yeah, absolutely. On that private equity point, Matt, the report says that PE participants were twice as likely to be buyers as sellers. I think we're going to see that sell side statistic go up, and the buy side is going to continue unabated. So I think it will be a driver of activity. The interesting thing on that front, there are sort of new pockets of liquidity opening up. One example are offshore funds, mostly traditionally sovereign wealth or sovereign wealth adjacent, who are now willing to take minority positions in operating businesses. We saw it on the Estia deal where we were acting for Axide. Axide also did a similar deal on La Trobe. I think we're going to see more and more of this sort of minority but significant stake, and it could be used in two ways: for a sponsor holding an asset to achieve some liquidity, reduce their exposure to a particular asset, but also financial sponsors looking to acquire a new platform, teaming up with these sovereign wealth or sovereign wealth fund adjacent type investors. So I think that's a new pocket of liquidity that's opening up, and we're going to see more deals of that kind.
Look, it's really exciting. I think that will be a trend we'll see more of, and that's, I think, one of the great things about, you know, private capital. They're always thinking about new ways of doing deals and structuring things differently. And I think that is definitely going to drive a new wave of activity. And that's exciting because we do want to see different ways of deals being executed. It is an important thing to be flexible. And sometimes you can't take a controlling stake in a business. So you can actually get comfortable with a minority stake. And that gives you different rights and a different risk profile, but it also probably gives you a little bit more flexibility. The other thing I think you touched on, which I definitely agree with, more co-investments, more consortium bids. You know, that is also a trend that I think will continue, and that helps drive bigger deals, because to execute on a big deal, you need a big check, and it's often easier to get a big check banked if you've got a number of different investors clubbing together to drive, you know, the closure of the deal certainty.
Absolutely. And so we talked earlier about options for people exiting assets expanding. One is this minority sell down effectively. The other is continuation vehicles. And what I'm hearing in the market, there are offshore funds that are actively looking for opportunities to provide liquidity to LPs in the form of funding a continuation vehicle. So that's sort of the offshore support. Southeast Asia is very focused on our market, and continuation vehicles are fairly nascent still. We don't have the deep market for them that the US does, but I think we're going to start to see more and more. And certainly when we talk to sponsors about exits, it's now a possibly quad track process, historically a dual track, and people are saying, what about a minority sell down? What about a continuation vehicle?
Yeah, and look, a lot of the private equity trends often start in the US and then move around the world, and continuation funds is a good example of that. Very common in the US, and I think it will become a more common feature of our market. I suspect it will take a little bit of time, but I do think it will come, and I think it's always good to have different avenues to facilitate an exit, because in the end, we want to make sure that the market is strong. And how is the market strong? You have different alternatives for liquidity events, and this will offer another mechanism which I think will be well received by the market.
Absolutely. So we've spoken about private equity predictions. What about on the corporate side? What are you going to see there?
So on the corporate side, I think there are a lot of corporates who have diverse arrays of businesses, and they're probably going to look to focus on what they're really strong in. And so I think we will see more strategic reviews, we will see more specialization into smaller business units, and I think that will drive more carve-out sales. Non-core divestitures are a key driver of corporate activity. The other thing I think we'll see is consolidation in certain sectors. And I think this was something you've touched on in another podcast, but financial services is another example of a sector where I think it's ripe for activity. I think there will be some consolidation in financial services, particularly in superannuation. I think that's really exciting.
Absolutely. And I'm very excited by the carve-outs, because that means two of our client sets come together, the corporates selling and the private equity or financial sponsors often buying. They love a good carve-out, Matt.
They do love a carve-out. And look, carve-outs are fascinating. There's a lot of complexity in carve-outs, but there's also a lot of interesting issues that come out. And having done many carve-outs over the years, they're one of the most enjoyable transactions to do, because they really bring together every aspect of an M&A deal, both the good, the bad, and the ugly.
Yeah, and of course it involves a wide range of specialists. So our firm is uniquely well placed for that sort of transaction. And in fact, our experience in it is surpassed by none. Okay, very good. The last prediction I want to give you, Matt, is everything old is new again. And I think with the AI risk that's emerging, we're seeing a lot of people focus on what about those old world economy assets? For example, business services, more on the blue side of the collar than white. What about things like facility-based healthcare that is less disruptible by AI and in fact enabled and growth enabled by AI? And thirdly, even glimpses of, dare I say it, manufacturing and interest in manufacturing again. So as I say, everything old is new again.
Look, I think you've touched on something really, really positive. There are going to be opportunities for businesses that were out of favor to come back into vogue. And I think Jamie Dimon from JP Morgan, said overnight that this is about as good as it gets. And what he was referring to was valuations of Gen AI companies and just how the market was viewing those. And so I think it could signal that we're towards the top of the market with those types of assets. The valuations are very frothy, but there are a lot of other businesses which have probably been undervalued while people have been focused on the shiny new toys. And so it will be nice for other businesses who've perhaps been a little bit unloved to get their time back in the sun. So that's exciting as well.
Maybe a sub-prediction for SaaS M&A, Matt? All right, we'll leave it there. Well, look, as we said, this is the Private M&A Report, the Dealmakers Report. It's just been released. There is a wealth of data and know-how and insights in that report. Must reading for all deal makers. Matt FitzGerald, thanks very much for joining me today.
Thank you, Cam.